Hello, everyone, and welcome to the session. It is my pleasure to introduce Avi Gilbert, an Elliott Wave market analyst and the founder of ElliottWaveTrader.net, a live trading room featuring analysis by a dynamic community of professional traders. Now, to our live viewers, Avi's looking forward to answering your questions today on the S&P 500 gold and silver. Please share any questions in the live chat box and be sure to keep today's focus in mind. Now, with that all said, Avi, I will hand the mic on over to you. I'll be here if you need me, but the floor is all
Hey,
yours.
thank you so much, Charlotte. Welcome, everybody, and thank you for joining me this afternoon. Just to add to what Charlotte says, please wait till the end before you ask any questions. I greatly appreciate that. Oftentimes, I will get to your questions before you have to ask them, so it's best to wait till the end to ask them. And if you're going to ask the question, please try to keep it on topic and please post your question in a full English sentence and reference the charts that you're questioning. If we can't understand your question, we're not going to be able to answer them. And I promise I will leave plenty of time over for questions because usually a lot of the best information comes from the questions. So I will usually leave at least half an hour for questions. Much will depend on how long it takes me to go through the various charts that I've got. So let's get started. Just to give you guys a quick background, for those of you that don't know me or don't know what Elliott wave analysis is, let me just give you a very quick basic background. Back in the 1930s, there was a gentleman named Ralph Nelson Elliott who basically discovered that the market develops through a self-similar pattern that you'll see over and over and over again. And he identified that that pattern is driven not necessarily by fundamentals, but it's driven by mass sentiment, by market psychology, will you? I mean, a lot of you probably have heard that, when a market tops is when there are no more buyers, and a market bottoms when there are no more sellers. So in other words, when you're reaching extremes in sentiment, that's when you see the major turns in markets. And Elliott basically codified that into his 5-wave system. He identified that markets move in 3 waves within the trend. Waves 1, 3, and 5 are with the trend, and waves 2 and 4 are counter trend. I have a very large structure of the S&P 500, and I'll use that as an example, along with explaining where I think we are in the S&P. So one other thing I also want to mention that Elliott identified is that all the waves are self-similar at all various degrees of trend. That's based upon the fractal nature of the market. What does that mean? Well, waves 1, 3, and 5, as I said, that travel in the direction of the market subdivide themselves into 5-wave structures. And I'll show you as an example, wave 3 here at the top, which topped at the 2000 tech bubble, actually began, that's Roman numeral 3, actually began back here in the late 40s, in the early 40s. So you have the wave 1, 2, so wave 2 bottomed here, and you had this entire large wave 3 that was a multi-decade wave 3. And if you look at it, we even subdivide that wave 3 into 1, 2, 3, 4, 5. And then you could go further and further, deeper and deeper into the subwaves, and you would probably see the exact same thing. Each subwave will further divide into 5 waves. So that's what it means by it's self-similar at all different degrees. Wave 1, 3, and 5 will subdivide into 5 waves themselves. And then you go into those 5 waves and their 1, 3, and 5 will subdivide into 5 waves as well. And it goes on ad infinitum. You can go all the way down to a tick chart with this. So interestingly, I just pointed out that this subwave 2, this smaller degree, wave 2 here, that bottomed in the early 40s, actually coincided with probably one of the best market calls I've ever heard or seen in my entire life. And that is when Elliott himself came out and said, we are about to embark on an 80-year bull market. 70, I think he said 70 plus year bull market. Now, what was going on in the early 40s? when he made this prognostication? Yes, World War II was going on around him. And this is as people were coming out of the Great Depression. Can you imagine how much negativity there was there? Well, Elliott recognized that negativity was reaching an extreme, and he expected that extreme to then complete a very long-term bear market and then begin what he believed was going to be a 70-plus year bull market. Again, one of the best calls I've ever seen, heard, or read in my entire life. And unfortunately, what I'm about to tell you, and for those of you that have heard me in the past, what I'm about to tell you is we are coming to the conclusion of that 70-plus year bull market. Now, what I want you to take note of is a one higher degree structure. I was pointing out this 1, 2, wave 3, 4, and 5, but I'm pointing out that for a reason, because that is the 70-plus year bull market that Elliott was calling for. Now, as you could see, that five-wave structure, that 70-plus year bull market structure that Elliott was calling for, completes this paren Roman numeral wave 3. That began at the bottom of the 29 market crash, which I think bottomed 1931, 1932, and that bottom right here. So that's that paren 2. That's the corrective structure that then led to this very long-term trend to complete this wave 3. Now, because I'm an Elliottician, but I also learned how to count to 5 when I was very young, I know what comes after a wave 3. And that's a wave 4. And as I said before, waves 1, 3, and 5 move with the trend. Waves 2 and 4 move opposite the trend. It's a counter trend move. And that is the expectation I am maintaining that I believe is going to be ushered in for the next decade, could be as long as 2 decades. Why do I believe it's going to be that long? Well, when I mentioned before that markets are fractal and that they are variably self-similar at all different degrees, I pointed out that we had this 5-wave structure that comprised this entire rally from this Roman numeral 2 paren all the way up to, as we're completing, this Roman numeral 3 paren. So I pointed out this 5-wave structure. If you look at waves 3 to 4, you will notice wave 3 topped in 2000 at the top of the tech bubble. We then had a multiple year decline for the first leg of that wave 4 correction. We then had a multi-year rally in the B wave segment of that multi-year correction. And then we had the financial crash, the housing bubble and the financial crash of 2007 into 2009. And that marked a 9-year, 8.5-year, 8-year, whatever you want to call it, bear market. And that was a 4th wave of one lesser degree. That was the 4th wave that comprised within the 5-wave structure of this wave 3. So if that is the 4th wave of this wave 3, and I'm looking for a wave 4 of one larger degree, my expectation is that it is likely that that 4th wave is going to take longer and become bigger than a 4th wave of a lesser degree. So if the 4th wave of a lesser degree took us 8 to 9 years, my expectation is the 4th wave of larger degree is likely going to take us at least 10, 11 years, at least. So my expectation is I think you're probably in for a 13-year, Fibonacci 13-year bear market, and it could be as long as a 21-year, Fibonacci 21-year bear market. Now, I am not a prophet. I am a simple analyst, and I am providing you the basis within the methodology that has given us all these various predictions that you've probably seen from us through the years. One of the predictions that I made, and I'm going to remind you of this for a reason, because you may now think of me as an uber bearish person. You may consider that I am an uber bearish person because of my of this view of looking for a very long-term bear market. But I want to remind you that I'm the same person who was pounding the table towards the end of the COVID crash, saying this is a buying opportunity when everybody else was losing their mind. So I don't just take bearish positions because I'm always bearish. I take bearish positions when the charts tell me to. Many of you remember my bearish position in early 2011. I'm sorry, in mid 2011, in the summer of 2011, when I was looking for a major top in gold. And everybody was so certain gold was at that time going to fly through 2000. And we got that multi-year correction we expected in gold as well. And then I went uber bullish in gold when everybody else had become uber bearish after those 4 or 5 years during that bear market. So I'm not always bearish. I'm only bearish when the charts are telling me to do so. So as it stands right now, I personally, I think, have over 80% of cash in my accounts. I have reduced my holdings quite significantly based upon where I believe we are in this very long-term trend. Now, I'm going to hone in a bit more, and we're going to take a look at some S&P charts. Now, this is my monthly chart. The chart you just showed was done by one of our analysts, Garrett Patton. That's 100+ year chart. So I'm going to hone in a little bit more. As you can see, this is the A over here is the ABC that finished off that fourth wave of one lesser degree to which I was discussing before. And you could see that the market is very nicely breaking down into a 5-wave structure here that is completing the 5th wave off of this 4th wave. We have a 5th wave rally. It's this Roman numeral 5 that is completing off of this Roman numeral 4. And that is what I am viewing us in the final throes of completing. Now, mind you, when we were bottoming here and I was pounding the table to go long after the COVID, towards the end of the COVID crash here, my upside expectation ideally was no higher than 6,000. I was thinking 5,300 to 6,000, 5,500. I forgot exactly how much to 6,000 was really my ideal target. And we have clearly exceeded the ideal target I had. And if you remember, we were at 2,200 here. I think 2187 was the exact bottom. But my expectation was for the market to come close to tripling at that point. I did not expect clearly at that time we were going to extend this high. And at this point in time, I still do not have a clear indication that this rally has even completed. And I'll show you what I'm looking for to consider that this rally has completed. But overall, my expectation is once we do complete this, I'm showing a general path. Now, what we know about 4th waves is that they are quite variable in structure. They take a general ABC structure, usually. Sometimes they can morph into a triangle, but most of the time they take a 3-wave ABC structure. The A wave is comprised of an ABC itself for the most of the time. The B wave is an ABC rally, and the C wave is usually a 5-wave crash. Just so you know, the COVID crash was a C wave. The great financial crash was a C wave. C waves are also known as crash waves. So my expectation is we're going to see a number of them through this long-term bear market. And one of the things we also know about 4th waves is that they're quite variable in nature. So whereas I'm putting here a general path as to what I think we may see, recognize it is nowhere near written in stone. As I said, fourth waves are very, very variable. So they could take many, many twists and turns within this general path. So I'm just providing a general path that is, it's pretty easy to see with your eyes, but it does not necessarily mean that this is exactly the path the market is going to take. This is just a general path. So again, I'm going to remind you, I am a simple analyst. I am not a prophet. I can only give you something within the parameters of what I can see and can foresee. And generally, this is a general view of how I foresee this next bear market going. Again, this could easily form as a triangle, but for now, I am viewing it as this is a general path I'm expecting. My ideal target for this long-term bear market, and I hope many of you are sitting, and I know this is going to sound completely outlandish, but I'm going to say it anyway. My general target for this is going to be as deep as the 1100 region on the S&P. It could be as shallow as the 2000 region. But the general target is pointing us towards the 1100 region. Why do I say that? Well, Elliott has also given us general guidelines as to where to expect, large degree corrections to take us. Most of fourth waves take you back to the fourth wave of one lesser degree. And if you remember what I mentioned before, the fourth wave of one lesser degree was completed by the great financial crash of 2007 to 2009. For those of you that remember where that bottomed, that was 666. Yes, the sign of the devil. And that is where that fourth wave of one lesser degree completed. But Elliott also told us that if the fifth wave provides us with a sizable extension, then we may only get back to the second wave, the bottom of the second wave of that five-wave extension. And that's why I'm saying about the 1000 to 1100 region, because that is where the second waves reside, right in here. So that is why my ideal target is about 1000, 1100, somewhere in that region. And now, if you think that this sounds crazy, and I know it sounds crazy, I will tell you, I have given predictions like this that have sound just as crazy in the past, and they've almost all come to fruition, even though it sounds so outlandish. I mean, through the years, folks, I've been doing this for a number of decades, and through the years, in the beginning, I would look at my chart and I'd apply these standards, and I would say to myself, looking at the chart, I'm like, that can't be. I can't tell you how many times I've looked at it, used these standards, and said, no, that just can't be. And you know how many times it can be? So, I'll give you a great example. I'm going to go back to 2011. And I made a call in the summer. It was in August 2011 that said, everybody at the time was expecting gold to fly through the 2000 mark. And I was using an exact target, 1915 or 1916. I forgot exactly the target I had. And I put out an article saying, is actually one of my first public articles with my analysis, saying that this is where I expect gold to top. And at the time, gold was rallying parabolically. It was rallying parabolically, and I had the chutzpah to put out an article like that. Now, needless to say, because it was my first article, nobody knew who the heck I was. Most people in the comment section really started going after me. You know nothing. What is this, all this gobbledygook? What are you talking about? You know nothing about gold. Well, one person actually paid me a little bit of mind, and he actually asked me a reasonable question. He says, well, where do you foresee gold going if you think it's going to top at 1915? I said to him, well, I think there's a very strong probability that we'll get back down to the 1000 region. And after I wrote that, he then proceeded to tell me that I know nothing. There is no way. That is impossible. I was looking for a 50% decline in gold during the point it was going to a parabolic rally. Today, we know gold topped within $5 of my upside expectation, and it bottomed at 1,050. I did not make these standards. These are the standards that Ralph Nelson Elliott himself came up with. And he was the one that called the bull market from 1941 when sentiment was at absolute negative extremes. And I will tell you, the methodology, is it perfect? Absolutely not. Like anything, there's nothing you can utilize in the markets that are perfect. It is impossible to be perfect in the market. Nobody will ever be perfect in the market. But for those that have followed me during my 15-year public career, I think you've seen that we are quite accurate. We're not perfect, but we are quite accurate in many of our larger degree calls. Admittedly, I did not expect that we're going to go past 6,000 on the S&P, and look where we are. So clearly, the market is pushing a little bit further than I had expected, and we're not done yet. The market still hasn't given us an indication we're done yet. But ultimately, I am expecting this larger degree bear market to take hold over the coming years. So let's talk about what is it going to look like when I think we're done. Well, let's take a look at a daily chart. Okay. Now, this is if the market is indeed topping in here, and that is a very strong likelihood, ladies and gentlemen. My expectation is we will break down below the B wave low. In other words, the low we just struck at the end of March. That is the high water mark right now. Should the market break down in the coming weeks and months below that level that we began this rally at the end of March, that is your first indication that a bear market is potentially begun. Should the market then rally off wherever it bottoms after breaking that low in a corrective manner, and then break down below wherever it bottoms there, that will confirm to you that the market has likely begun a long-term bear market. That's what I'm looking for as a signal to tell me it is now time to move into a bear market stance versus a bull market stance. Where we are, that could still extend this into the coming year or so. Well, if the market provides us with a corrective pullback in the coming weeks, and then gives us a 5-wave rally off of that corrective pullback, then I'm going to be looking to buy back into the market over here. If it gives us a corrective pullback, 5-wave rally, and then another corrective pullback, I will be buying that corrective pullback, and I will be looking for one more rally to complete this very long-term bull market, taking us probably well into 2027. However, I'm going to say this again. Should we break down strongly below the March low of this year, that is your initial indication that a long-term bear market has begun. So that is the general perspective that I have about the S&P. I have not determined that any bear market has begun yet. I am expecting a bear market to begin, but I am seeking confirmation before I do so, and am leaving the door open in the coming months through the summer to see if we get a setup that's going to take us for a rally well into 2027 before this completes. That's the general perspective of the S&P that I wanted to present tonight. Let's move on over to metals. And I'm going to start with my gold monthly chart. Now, gold clearly went through a majorly parabolic rally. Now, mind you, it was April of last year. We were, it was about here. 23, 24, right about here. It was around here that I started pounding the table that I think we're about to go into a parabolic rally, especially in silver. I was mostly focused on silver going into a parabolic rally. I didn't expect gold was going to join it to the degree it did. I did not expect that gold was going to rally as high as it did, but I clearly was expecting very large moves in both. I was expecting silver to go, we'll take a look at it in a minute. I think it was in the 20s at the time, and I was expecting it potentially to go up to 60 to 80. So even silver exceeded my target as well. We utilize our targets for standards, and when we hit targets, those are the points in time where I say, okay, now is the time to not be as aggressive. When you get to the target, now it's a time to take down your aggressive postures, and then you allow the market to continue and you start peeling off your regular positions as the market continues higher beyond those standard targets. That's how we apply risk management. So by the time the market tops, we are pretty much, at least that's how I approach the market. I'm pretty much heavily in cash by the time the market approaches a target. And in fact, I was almost 100%. Now, back in the late part of 2015, I started buying heavily into mining stocks and gold, and silver. I was buying heavily. By the time we got up into the January timeframe, in my mining stocks, I was buying mining stocks at the end of 2015, and I had not sold almost all of it until we got into 2025. Once we got into January 2026, I was almost completely out of all my positions of mining stocks. I think I had less than 1% left in my mining stock positions by that time. So that's how I personally approach the market. Many people were still expecting gold and silver to just continue parabolically. Problem is, markets are not linear. So you have to at least approach the market from a non-linear perspective. Our analysis is a very non-linear analysis perspective. So once I knew we were coming to the conclusion of that structure, I knew to expect we're going to go into a corrective structure. Problem is, most people don't understand that market context. I always say that Elliott Wave, one of the best tools Elliott Wave is used for, is to understanding overall market context. Most people thought after that first drop that we got in January, most people thought, great buying opportunity, we're going back to the highs. No, that first drop was just a shot across the bow telling us the correction is now beginning. That was not a signal to say, oh, we're about to start up again. And the correction is still ongoing, ladies and gentlemen. Let me show you where I believe we are on a gold chart, a 60-minute gold chart. And this is going into a little bit more depth. Now, as you could see here, that was the top of the market. You can't see it here, but that's the 5. But that was the top of the market we ran into. And then you got this first decline. You got that first decline, and that was the shot across the bow. Everybody thought we're going to rally back up to new highs. You got another shot across the bow. And at this point in time, I do not believe this correction is done. I think we probably are going to at least the 4,000 region before I believe this correction can be complete. I'm not sure if we're going there directly. We can get down as low as 3,600, by the way, but I'm thinking the 4,000 region is going to be my minimum target. We can get down there directly from here. I much prefer seeing a more prolonged structure. Meaning, if we can get one more rally, I'd like to see one more rally taking us north of 5,100. Could be as high as 5,500, but I think the 5,100 to 5,300 is really a good target. And that's going to set up one more decline that's going to take us down to the 4,000 region, maybe as deep as 3,600. When we get down to this region here, folks, that is going to be your next major buying opportunity. And I'm going to say this again. I'm an analyst, not a prophet. There's only so much I can foresee. After we complete this, I don't know if the next rally thereafter is going to be taking us to new highs, or if we're going to be stuck and mired into a 2011 type of correction where it's going to be taking us much longer. The way I'll know is the manner in which the market rallies off of this low. If it rallies off of this low in a 5-wave structure, then I'm going to be prepared to say we're about to get a pullback, and then we're going to be heading to absolute new highs. We could be going up to the 7,000 to 8,000 region from there. But right now, there's no way I can know that yet, because if the rally thereafter is clearly corrected, we're going to be mired, or likely mired, in this correction for at least another year, maybe two. And it probably will be taking us much lower than where we are, than that 4,000 region, going back to gold. GLD, you can see, I think GLD can take you back to at least 250 on GLD. Could be deeper. As you can see, I have that very large wave 4 now. So I am not sure if all we're doing is completing this here and then rallying to new highs and then starting that larger degree correction, or if we are going to be mired in this larger degree correction for a number of years to come still. I can't tell you that yet. I'm not going to know until I see the rally off of the 3,600 to 4,000 region. Silver, pretty much same perspective. Silver, I was pounding the table when we were below 20 to all our subscribers. And I was saying, guys, anything you buy in silver below $20, you will be a very happy camper into the future. I am now changing that perspective, and I am saying anything you buy below 60 now in silver, you will be a very happy camper in the longer term perspective. I think you can get down to as low as 35, but between 35 and 55 is going to be a sweet spot that if you begin to load up again in that region over the longer term, you're going to be a very happy camper. I'm looking at silver in the same way that I am generally looking at gold. And I think silver has potential for higher upside into the future from a percentage basis. But again, I'm telling you the same thing. I don't think we are ready yet to head to those lower lows. But if we do, that's going to be your buying opportunity. However, if silver is going to rally off of that in a corrective fashion over the coming years thereafter, then all it's telling us is that is a corrective B wave, and it's going to give us another C wave down, crash wave, and that's going to be your next buying opportunity. And from there, you'll see a major rally begin. That's my bigger picture in silver. So in the near term, I still think we're going to be stuck in this corrective up-down market. I think it'll resolve with a move lower, either more directly now or after a rally is seen, and then we come down. The ideal target for silver is about 53.50. It could be lower than that. We'll have to see. But ultimately, that will be your next major buying opportunity for silver. And for gold, it's 3,600 to 4,000. Now, that is my general view of these three charts. We've covered these three charts from a general perspective. And I think, Charlotte, I think we can open it up to questions at this point in time. I said I'd like to leave it for questions. So let's see if there are any.
Well, Avi, we do have a couple questions that already came in while you were presenting, so it's entirely possible that you have covered these already.
I told them not to.
I know. No, I did just let them know in the chat they are free to share questions at this point, so we'll see what new ones come in. Back when you were going over the S&P 500, we did have David asking if the current V wave could extend even further to 6 to 18 months before completing.
You mean I'm assuming he doesn't mean the current B wave. He means the rally structure. B wave is usually a corrective structure. I think he's saying the rally structure. And the answer,
yes.
I answered that absolutely, and I answered what we're looking for. And yes, it can take us into next year. So I answered that so he asked the question before I had the opportunity to answer it, but I answered it in my presentation.
Yes, fantastic. And now we do have a few more questions coming in. JJ just asked, if we get high inflation this year, what do you think happens to gold and silver?
Oh, I love these questions, these fundamental questions. Ladies and gentlemen, I don't know if you know my background. I trained in economics. I have an economics degree. I have an accounting degree. I have a law degree. I have a master's of law in taxation. I have a CPA. I've been through it all. So one of my majors was economics. I was trained on economics. I started my investing career doing fundamental analysis. And it took me a number of years to figure out, why am I not really doing much better than most everybody else? I know more economics than they do. You know, more and more studies have been performed today that explain to us that, and more than just studies, but empirical evidence tells us economics is not the right methodology to utilize when you're looking at the world of finance. Mandelbrot himself, the mathematician Mandelbrot, said the same. Now that we have the fractal basis for market analysis, you have to distinguish between economics and finance. Interestingly, for those that know their economics, there is a gentleman that was named Samuelson who gave us the efficient market hypothesis. And when he was asked in an interview back in 2010, he was asked in an interview, well, how are you doing with your economic basis for analyzing markets? He says, well, I've given up macroeconomics. It doesn't work. I mean, the person who came up with the efficient market hypothesis, which is the main perspective that we apply economics into the world of finance, said he gave it up. It doesn't work. Now, when you ask economists today, why is it still used as the basis of teaching the efficient market hypothesis and all of the theories within economics? It's still being taught as the basis for finance today. The answer is because we don't have anything better. So if you're going to ask me about an economic theory called inflation, and you're going to tell me that should cause gold to rally, I'm going to give you a two-pronged answer on that. The first is going to be from a theoretical standpoint, and that is, I'm going to tell you exactly what the originator of the efficient market hypothesis said. It doesn't work when you're dealing with finance. And two, I'm going to tell you empirically, during the periods of inflation that we had a number of years ago, did gold rally? It did not. Did gold rally during QE? It did not. It crashed during QE2 or QE3. I forgot which one. It crashed. So, ladies and gentlemen, please move away from the thinking of the way most of market participants think. Most market participants have been droned into their heads. Inflation causes gold to rally. Empirically, it is not true, and theoretically, it is not true. So I'm sorry to answer the question in that way, but I'm going to tell you, move away from your theory of inflation. And then you ask me, what do I think is going to make gold rally? I will tell you, gold will rally when it completes this correction. And then the nature of that rally will tell us if it will rally to new all-time highs or if we're going to be stuck in the correction much longer. So my answer is exactly the same as I said during my analysis, but I'm now applying it to the world of economics, if you will.
Thank you, Avi. We do have a few more questions that have come in. And of course, as you know, I am not a financial expert myself. This is my job. So if any of these questions are things that have been covered, just let me know and we'll move on, okay?
Mm-hmm.
So this first one from Jerome, he's asking, what is the target lower GC must reach that will tell us that we're headed to below 4,000, or the target higher that'll tell us we're headed first to 5,300?
It's not necessarily a target per se. A lot of it is based upon structure, to be honest with you. And because we are involved in such a complex structure, I mean, I would probably say if we break down below this low here that we struck about a week or so ago, a week or two ago, that opens the door for the more direct path. As long as we stay over it, I'm still looking for the path higher before the path lower. So that's basically how I'm looking at it. It's really a lot more complex than that, and it's all based upon structure. When it comes to silver, probably, I mean, silver's coming close to breaking down already. Uh, Silver may be telling us we're going directly there. Um, Again, I'm going to have to see how the structure develops to be more certain, but we can easily go straight there. But if you take out this 80 region, then you're probably looking at my ideal target is about the 95 region higher before we begin the drop lower. So 90, it would be 95, 94, 95 up to about 100 to 103 would be the ideal target zone for this corrective rally if we get it. But I'm not sure we're going to get it. We'll have to see over the next couple of days. Any other questions?
Absolutely. Next up, this is from Andrew asking, do you consider a blow-off top in the Nasdaq similar to the 2000 top possible within your market thesis?
Well, there's no question it looks like a blow-off top now. But, whether it's a blow-off top or not does not change the overall analysis in determining whether the bull market is done. So, you may want to call it a name, but it really does not have any implications necessarily for how we confirm whether the bear market has begun or whether the bull market still has further to go. So blow off top or not really is not as important.
All right. This next question is from Joe. He is asking in general, do you see bear market rallies during the downturn?
Oh, absolutely. I mean, as I said before, I gave you guys a path on the monthly chart. And I want you to realize, I want to go back here a second, and I want you to see, let's look at it this way. This ABC was just a large degree ABC structure. What do we see in it? We saw a multi-year decline. We then saw a multi-year rally, and then we saw this crash. We're going to see a number of these at all different wave degrees within this long-term trend. So once we do confirm that we're going to be going into this bear market, we're going to get an A wave that's going to drop down. I'm not exactly sure where it's going to go yet, but this isn't a guesstimation as to where we'll come down to. Somewhere between 4 and 5,000 is probably where we'll come down to for the first move down. And then from there, you'll probably get a year, maybe 2, maybe even 3-year long bull market after that. Not bull market, but corrective bull market. In other words, it will remain within the bear market, but it still can be a multi-year rally. Then you're going to get a crash. Then you're going to get another multi-year rally. And this second one, because it's a higher degree, can actually last as long as 5 to 7 years, maybe even longer. It really depends on how long this entire correction takes. So that one can last for multiple years again. So the answer is absolutely, and I'm expecting investing opportunities for those multiple years. So remember, an A wave usually takes shape as an ABC. So when this drop occurs in an ABC structure, I'm going to expect, as that C wave is completing that bigger A wave, I'm going to be looking for an opportunity to put money to use for what I expect to be a multi-year rally thereafter. And as that's completing, I intend to cash out and then look for how a crash will begin. And then I'm going to do it again. Once this C wave is completing a larger degree A wave, I'm going to be looking at this as an investing opportunity for another multi-year bull market that's only going to set up another crash. So absolutely, you're going to have opportunities where you will have multi-year investing opportunities even during a bear market. As I said, we had it here. This was a 9-year or 8.5-year bear market. And yet you had 2003 to 2007. You had a 4-year period of time where you were in a corrective bull market. And I expect similar types of scenarios in this longer term bull market. Yes.
Thank you, Avi. Now I do have another question related to inflation here. This one's asking, it's from James. He's just saying he's wondering if inflation can affect your long-term price targets. For example, if it was high for the next 15 years, would one want to adjust your a 100 level to a 2040 upwards, or does that just come out in the wash?
As I said,
Yep.
inflation is an economic theoretical term, has no bearing. Many people will try to apply it to markets, but they're the best example I'm going to give you again. Let's go back here a second. Let's go back here 1 second. I'm going to show you guys something so you could see it with your own eyes. Inflation was big here. Remember how we were all hitting that inflation here, guys? What was gold doing? Nothing. Gold was doing nothing. It was going down and or sideways during a period of inflation. If you don't believe your eyes, I don't know what else to tell you. But this was clearly a period of inflation, ladies and gentlemen. Gold was not doing anything during a clear period of quote unquote inflation. So I'm going to ask you again, Yoda had a great line, you must unlearn what you have learned. There is so much fallacy out in the market, so much. You really have to take the main propositions that you have been taught all these years and run them through a prism of truth, run them through a prism of market facts. People will postulate things all the time, and that gets regurgitated, and people believe it as truth. Kahneman talks about this all the time in Thinking Fast and Slow. He talks about that. Just because people say it does not mean it's true. So please take these economic terms out of your vocabulary if your goal is to be on the right side of the market.
Thank you, Avi. This next question from Jerome. He says, in the last 5 weeks, silver has reached the $71 area twice. Can we assume that if silver breaks $71, almost there for the third time now, that the lower path is then ongoing directly?
I kind of answered that, and it really is based upon the structure with which we break it, to be honest with you. So I'm going to leave that open for now. But I would say that if we start breaking 70 and 71, yeah, you start to move into that potential. But I want to see the structure with which we break that before I'm willing to assume that we are heading down to at least the 53.50 region. That is my main ideal target. Could extend as low as the 40 region in silver, as you could see from this chart. You see my big target box down there. That is my target to complete this initial stage of the correction. I need to see how the market develops in structure to make sure that we're heading down to there in a more direct path rather than the indirect path.
Thank you, Avi. I have a comment from Joe saying, so the operative words here are patience, grasshopper in the metals complex.
Oh man, let me tell you something. That is a word I use with my clients all the time. One of the things that I harp on all the time is understanding market context. When you understand market context, it tells you how to approach the market. When you're in the middle of a large degree corrective structure, and you know that, and you have the power that Elliott Wave gives you is it tells you when to expect that. And with that expectation comes the knowledge that you're heading into a very variable, difficult, corrective trading environment with many starts and stops. And that tells you, as you're heading into that environment, that you're no longer in that big, beautiful spike higher anymore. You have to change your mentality. And when you move into corrective structures, patience is probably the most important word. You have to wait for a good setup, because it's not like it was before that you buy every pullback and it's going to go higher. You have to understand when you're moving into a different environment. And we are and have been in that different environment since January. So yes, patience is of utmost importance right now. I 100%.
Yes, patience is it's a virtue, that's for sure.
And many of
Now
us
we
are not
do have
terribly virtuous.
that's so true, Avi. We do have a couple more questions here. I'm not sure how relevant they are to the topic though. One was asking for your targets on TLT.
Keep moving.
Yep. The other one is asking about NQ and ES.
Keep moving.
Yep.
I'm not going into the minutia, guys. This
Yeah.
is this is really this is meant to be a much bigger perspective of how to look at it over the coming years in gold, silver, and the S&P. That's really the taste I'm trying to leave you guys with. If you want more detail, feel free to come join us. We have a 2-week free trial. You can check us out, but please, I'm trying to give you more of a bigger flavor as to what to look for.
Now, I think we are pretty much caught up on questions that are relevant to the topic today. Just a friendly reminder to those of you in chat, we are covering questions that are related to the S&P 500, gold, and silver. So please keep on topic. And with that, Avi, again, I do think we are caught up in
Okay.
terms of
If there are
relevance.
no further questions, and that's wonderful. We can all call it an evening, and I can thank everybody for joining us.
We do have, let's see, one more question here. We go from
Just a
Stan.
little higher.
He says,
Yes.
where would you invest during your period of patience?
It all depends on the specific period of patience. We're going to be going into a period of time where you're going to see something that you've not likely ever seen before, and that's the equity market crashing alongside with the treasury market. And that is not something we're used to seeing, but something that in 2010, 2011, the European debt crisis should have warned us about. And that is going to be coming to the United States. So, you're not going to have a lot of safe places during certain periods of time in that bear market. You're going to need to be able to house your money in safe banks. And that's a whole other topic that I can't cover now, because I can go on for an hour or two just on the whole safe bank topic. But you're going to need to find safe banks for periods of time during this market correction, because there are going to be periods of time where being in the market is going to be too dangerous. Being in treasuries are going to be too dangerous. You're going to need a safe harbor, meaning safe banks. And if you want to learn a little bit more about that, we have this other website where we specifically focus on that, and that's called saferbankingresearch.com. And that's a whole other topic. Like I said, I could spend hours on that alone. So, for real safe harbors during certain periods of the long-term bear market, you're going to want to have your cash in safe banks.
Thank you, Avi. And we do have one more question that just came in, so we can finish it off with this one. Johnny's just saying, on the S&P, how much more can it extend in Blue Wave 1, and where do you expect Blue Wave 2 pullback to complete?
Well, when we have Blue Wave 1 done, then I can give you some estimations on Blue Wave 2. Second wave pullbacks are generally a percentage of the Wave 1. Minimally, you look for a 382 retracement. Ideal retracement is a 618 retracement of the prior rally. So I cannot give you any specifics yet because we do not have a confirmed top in this current rally we're in at the moment. Once we have a confirmed top in this, then I have target boxes actually put out for our members, but they'll have to be adjusted based upon where the market actually tops in the coming days, or if we have topped already. I just don't know yet. As I said, I'm an analyst, not a prophet.
Well, Avi, thank you so much for joining us today. It's been a pleasure having you on, as always.
Thank you, and it's a pleasure to share this with you again, Charlotte.
Absolutely. You always come with so much information, and I know that our audience definitely appreciates it. Now, to those of you who are watching live, thank you as well for joining us today in this Money Show Virtual Expo. We will be back online July 8th through the 9th for another virtual expo. We hope to see you there. If you want to come and meet us in person, see some of these speakers in person as well, we'll be in Las Vegas July 19th through the 22nd at the Caesars Palace Hotel, and we hope to see you there. Well, I hope everyone has a wonderful rest of your day. Take care.